Deal surgeons, elite masterminds, what's going on? This is Diamond Life. Just doing a loss review on oil, ICT daily bias. This is not something I practiced for years. I literally just came across this 2 or 3 months ago. Shamefully to admit. Okay, so basically, this is a S1 drawn liquidity here. Price closed below the previous low. Okay, and so this was an exciting thing to see because I see why I was wrong and I see what to do next time. I'm going to watch this video myself to help. Okay. So basically the way it works usually is if it closes below the previous day's low, and this closed pretty strongly, that it would usually take the previous day's low. If you actually practice this is really next level type stuff, but it's deeper than that. Okay. So what I would say was, looking back at it now, the S1 drawn liquidity, which I say S, which is structure one, meaning that if it simply closes below the previous day's low, then most likely it will take this low here. But it's not that easy. It's not that simple. You have to think. So the way it works is you still have to look to the left to see what the actual structure is. Okay, and I'm going to turn on the annotation soon. You still have to look to the left to see what the actual structure is. So price actually took out this high up here, which I did not see. I had the drawn liquidity down here. So I had an alert here and I had an alert here. And then when the alert for US oil hit higher, I'm like, what the hell is going on? And then I went back to take a look at it and I said, oh, okay, I see why. And I'm about to explain exactly why this is a drawn liquidity up here and it didn't go down here. Structurally, this is a S2 drawn liquidity, meaning that it was supposed to be down here based on S1, which means that if it just closes below a previous day's low, then yes, it will take the previous day's low. But S2 drawn liquidity is when you have to think a little more deeply about this. Okay, so let me turn on the annotations and explain why. I'm about to explain why the draw was up here versus being down here. Okay, so let me turn on the annotations. So it's not about taking a loss. It's about understanding why you took the loss, if that makes sense. So let's go to the weekly chart. So when we look at the higher time frame, first off, let's go back to ICT order blocks. Okay. Now, if you understand how this shit works for the real diligent students, these two are order blocks right here, right? It may look like that, but you have to look up at the closing price. Look at the top up there where it says CFDs on crude oil. Look at this. This one says the closing price says 71,334. Okay. This one says 71,331. Okay. So as I go higher in the numbers, if you look to the left, the higher I go, the higher the numbers get. So basically the bearish order block is the bullish order block is the one that's the lowest down close. Okay. So the one that's lowest down close is this one here, not this one. You may want to rewind that to really understand this ICT shit. Also, I didn't mark up the mean threshold. Okay. Which is here, which is 50% of the lowest down close candle. So why is that important? Well, we got to go down to the lower time frame to explain. So let's go down to the 1 hour and I'll explain everything. So this is what I should have seen. Okay. Now here's when you also have to mark up when the day is going to end. Okay. So this is when do you guys understand that on a daily chart, the new candle was formed at 5 p.m. Do you understand that? On crypto, it's at 8 p.m. It's at 2000. Is that 8 p.m.? 17, 18, 19, 20, 5, 6, 7. Yeah, 8 p.m. It's on crypto and I think Forex. It's at 8 p.m. But on crypto, it's definitely at 8 p.m. On indices, do you understand that the new daily candle for the day actually starts at 5 p.m.? Do you understand that? So this is what these lines are right here. So you have to identify this kind of stuff. So let's scroll the chart all the way to the right. So basically, before the new candle printed for Wednesday, the drawn liquidity was down here. Remember, I previously thought it was going to come down here. So looking back on it, price actually came up to here. Which was Tuesday's drawn liquidity. So I'm thinking and then I got an alert. So I was thinking what the hell is going on? This is supposed to be a S1 drawn liquidity. Price closed below. I just showed you on a weekly chart. But this is what I should have seen. Check it out. First off, we got a bullish order block down here. Okay, we got a bullish order block on the 1 hour chart. Now, price could have came down here to take this low, right? Also, let me give you another tip for people that really fuck with me. This right here, what I would say is you need to mark up the drawn liquidity for the day and then go down to the 15-minute chart and also mark up the highest or lowest up close candle that you see. Like for instance, this right here, this line right here, this dotted line. This is the lowest down close candle on a 15-minute chart. The reason I asked you to mark this up, let me show you what I mean for people that really fuck with me. If you go down to the 15-minute chart, okay, what I'm trying to tell you is that a lot of times, not a lot of times, but sometimes price will not take the drawn liquidity, the actual low. It'll reject off of that 15-minute low and go all the way up here. And you would have been waiting for it to take out the actual wick low. Now, it may do that. A lot of times to do that, but what I'm trying to tell you, if you mark up the one, if you look on the daily chart and try to predict if price is either going to take the previous day's high or the previous day's low, what I'm trying to tell you is that you want to mark up that previous day's low and mark up the 15-minute candle, highest up close candle or lowest close candle. Watch what I say. Just go back and look at it. You're going to see that price will sometimes reject off of that 15-minute low, which is ICT called a rejection block, and go the exact opposite way. And you would have been holding for the wick low and been SOL. So anyway, let me go back to the 1 hour chart. Okay, so I'm about to explain why I basically took this loss. Okay, so this is exciting for me to see, because it's not about taking a loss or being wrong. It's about knowing why. So again, I'm explaining why I thought the drawn liquidity was down here and how I was wrong. So what should I have done? What I should have done is said, okay, well, let's go back to when the candle, because remember, this is when the candle closed. Okay, the new candle on the daily chart started here. So I should have been like, okay, well, it makes sense for the drawn liquidity to be down here. I get it. Okay, but I need this to be verified. I need to mark up the mean threshold, which is the lowest down close candle on the bullish order block. If price closes below this area here, okay, and it wicks below here, then yes, price would have came down here and took this low. I probably would have got out the 15-minute low, like I just told you, but a lot of times it will take that wick low. I'm just telling you, you have to see how the candles close on a 15-minute high or low rejection block. So what I should have did was I said, okay, well, this could have been a quick scalp. Instead of me going short right here, because I just went short right here, just thinking like, okay, well, price is going to come down here and take this low because it's a S1 drawn liquidity. But I should have had confirmation for that, meaning if price closed below this candle, the mean threshold, and definitely if it wicked below there, then definitely it would be coming down here, and that would have been the structure, but it never did that. Let's scroll to the right. Now look, keep your eyes on this green line right here. Price never came down and closed below this candle. I mean, that line, which is mean threshold. Okay. So boom. So right here, we see that it actually took Tuesday's high, which is this wick high up here. Okay. It took Tuesday's high. Let me keep scrolling to the right here. On this candle right here, it took Tuesday's high. So that's when I got the alert, like what the hell is supposed to come down here? But this is the bullish order block opening price, this green line right there on the 1 hour chart. But I never seen a candle close below this mean threshold. Okay, this is the bullish order block mean threshold on the 1 hour chart. That's what this means, plus OB 1 hour MT, mean threshold. I never seen it come down here, and it didn't even touch it, nor did it wick below here, which would have invalidated this bullish order block and it would have went lower. So now I know that if I see a S1 drawn liquidity, okay, meaning that on a week or on a daily chart, if I'm doing the ICT daily bias, now I know that hold on, let me take this drawings off, then I'll end the video. So now I know that if I believe that price is going to take the low or the high, then I have to go down to the 1 hour chart or whatever time frame and see if the bearish order block is invalidated. Because this works all the time if you actually backtest it. If it closes below the previous day's low, the drawn liquidity is down here. But it's not that simple, okay? Like I told you before, on the weekly chart, we had a mean threshold on the weekly chart, and the mean threshold was literally right here where this wick stopped at. It didn't even touch it. It barely touched it. It was about 60 points off. Okay, so that was another indication that we probably was going higher. And when I went down to a 1 hour chart, I just showed you that that bullish order block was never invalidated to be able to take this low. Okay, so that's kind of where I messed up. It takes a more thinking than people think, and that's a good thing. Thanks for watching.